Welcome back to the channel. Today, we're going to explore one of the most important topics in the modern world, investing and finance in America. If you've ever wondered how people grow their money, when to invest, when not to invest, and what benefits it brings, this video will give you all the real knowledge you need. So, stay tuned until the end, because this could change the way you look at money forever. First, let's start with the basics. Investing simply means putting your money into assets that can grow over time. Instead of keeping cash in your pocket where it loses value due to inflation, you put it into opportunities that create more wealth. In America, the most common forms of investment are stocks, which means owning a piece of a company, bonds, which is lending money to the government or corporations, real estate, that's buying property for rent or resale, mutual funds and ETFs, which are safer ways to invest in groups of companies, and cryptocurrency, a newer, riskier digital asset. Each of these comes with different levels of risk and reward. America is considered one of the safest and strongest economies in the world. The United States stock market has been growing for more than 100 years. Even though there are crashes, history shows that in the long run, markets recover and grow stronger. That's why people across the world look at America as a financial hub. The benefits of investing here include strong economic growth, legal protection for investors, access to global companies like Apple, Amazon, Tesla, and Microsoft, and of course, compound interest, the magic of money growing on top of money. So, when should you actually invest? There is no single perfect time, but here are some golden rules. If the economy is stable and interest rates are reasonable, it's usually a good time. Long-term investors can start almost any time, because history shows that over 10 or 20 years, the market always rises. Dollar-cost averaging, which means investing small amounts regularly, is one of the safest strategies. For example, if you invest $500 every month in a United States index fund, after 20 years you could have hundreds of thousands of dollars, even if the market goes up and down in the short term. Alright folks, now let's talk about when you should avoid investing. If you don't have emergency savings for 6 months of expenses, don't risk putting money in the market. Seriously, it's important. And if the market is in a bubble, meaning prices are unrealistically high, it may be wise to wait. Never invest money that you urgently need. And most importantly, never invest just because of hype or social media trends. Remember, investing should be based on knowledge, not emotions. Of course, investing is not always easy. There are risks you must understand. Market risk means stock prices can fall suddenly. Inflation risk is when, if inflation is high, your real profit may shrink. Interest rate risk happens because when interest rates go up, stock and real estate values often go down. And emotional risk. Many people panic when markets crash, and they sell at the wrong time. The secret is, never invest more than you can afford to lose, and always stay patient. Now let's talk about profits and benefits. Historically, the United States stock market has given an average return of 7 to 10% per year. That means if you invest $10,000 today, in 30 years it could grow to more than $80,000 just by compound growth. Real estate is another strong option. Property values usually rise over time, and you can also earn rental income. Bonds are safer but return less, around 2 to 5%. Cryptocurrency can give massive returns, but it's very risky and unpredictable. The biggest benefit is financial freedom, the ability to let your money work for you instead of you working for money. If you are new to investing, here are some smart strategies. First, start small. Even $100 a month is better than nothing. Second, diversify. Spread your money across stocks, bonds, and real estate. Third, invest for the long term. Don't expect overnight success. Fourth, reinvest your profits. Let compound interest work for you. And finally, educate yourself. Knowledge is the best investment. Let's look at some real examples. If you invested in the S&P 500 index 20 years ago, your money would have tripled by now. If you bought a house in Texas or Florida 10 years ago, its value may have doubled today. If you invested in Tesla stock in 2012, you would be sitting on thousands of percent in profit. But remember, for every Tesla there are also companies that failed. That's why diversification is key.